So journal entries, just the name journal entries kind of tells you how they used to do this. Kind of like writing in your journal, like your diary, you know, write out what happened. Um, Same thing. They used to be written out, a paragraph or whatever on writing out the transactions. And again, this is back in the day where they dipped the ink, and and a handful of people could actually write. Um, so it was, if you were an accountant, 500 years ago, you'd be more like an English uh, instructor or something. I mean, you'd be more like someone who's very versed in English, like a scribe or something like that, because that's what they would do. And so this is sort of what a journal entry would look like. It'd be written out exactly what the transaction was. It was a journal, literally a journal that you write in. Well, over time, they got a little bit more streamlined with it, and they started saying, okay, we really don't need to write out everything. We can kind of do it in a shorthand way. Now, we're not going to, our journal entries aren't going to be this big. But they started doing it in a manner that would say, okay, this is, the account, and here's how it changed, and this is the other account, and this is how it changed. So they were able to kind of boil it down to what they call a journal entry. And this was actually a guy by the name of Pacioli was actually a monk that he's kind of considered the father of modern accounting, but he really wasn't an accountant. He was a mathematician, and he was just writing what were the most used best practices of the day in business. And he said, like, look, this is how the businesses that know what they're doing, this is how they're keeping their records. So he really was more like a documentarian. He did a lot in mathematics, all kinds of stuff in mathematics, but part of the mathematics was in business, and part was just record what went on. And he said, well, this is what the people that really know what they're doing are. So he didn't invent it, but he was the first one that kind of documented what a lot of the merchants were doing, especially the more sophisticated ones. He also did, he did stuff like mathematics for artwork and proportions of, he did a lot of stuff. But anyway, one of the things he did was write down these ideas about accounting, and that's what we're still using. Here, I'll show you a picture of him. Oops, no, that's not him. There's a picture of him. And I'm not sure who that is in the background, but someone photobombed his portrait. But anyway, he was very celebrated in his time, and rightly so, and even celebrated more maybe now. But anyway, so this is how it kind of came about, the modern idea that you can actually write things down fairly quickly, the transaction that you can do. So as we go through this, it's kind of important to realize that the journal entries, well, it is a little bit quirky the way that we do them. It's a whole lot faster than writing paragraphs about the transactions. So writing these paragraphs about transactions would be incredibly time consuming, which is probably why, as they got more busy, that they would try to streamline it. All right. So this is what a modern day journal entry looks like. Like this down here. So that's a modern day journal entry. Oops. I just kicked off my screen. Okay. So this, and we'll go over how we do this, obviously. This, though, replaces what used to be literally 2 paragraphs. Excuse excuse me, back in the day, they'd write a paragraph of what was coming into the business and a paragraph of what was going out or what was owed by the business. And this boils it down to basically grabbing two accounts, land, cash. This is all optional. I just put that in there. You'll see why in a second. Land and cash, and debits and credits, which, forget everything you know about debit cards and credit cards and all that. It has nothing to do with that, what we're going to do. But that is basically the first, this use cash to purchase land, 300. This is the journal entry for that. So that is the same as this. Oh, sorry. So this is the same as that. And the beauty of it, again, is like writing a journal, but it's such a shorthand that you say, okay, this is what happened to land. This is what happened to cash. Those two. So journal entries are actually very efficient, very time consuming. They're also very confusing because unlike a paragraph that everybody can read, not everyone can read this. Most people, they will look at this and they have no idea what it means. So while it is fast, it's efficient, there's some really good things about it. There's also some things that it can be confusing, to actually figure out what's going on with it. So basically, it's not for people that don't know accounting. Someone who doesn't know anything about accounting, this isn't going to make any sense to them at all. So it's basically a shorthand version of a journal. So this is going to save 2 paragraphs of writing, learning how to do it this way. Okay, so now at the end of this handout, right at the end, I have some things that are account names for debits and credits, and then there's also a thing about debits and credits over here. But I've also included a separate file, reason being, if you want to pull up both of them, you can. And this one has revenues. And we'll notice that revenues are credits. Expenses are debits. Assets can be either one, depending if it goes up or down. Liabilities can be either one, depending if it goes up or down. So basically you have revenues and expenses, assets, liabilities, and equity. Basically the stuff from our financial statements. And it's pretty amazing that this 400-year-old shorthand, everything that we do today, the craziest transactions you can think of, fall into these categories. Okay. Now, there's also this thing on the very last page, and this is kind of a oops. So debits and credits, expenses and assets, they go up with debits. Revenues, liabilities, and equity, they go up with credits. As we go on, these will become more apparent. But here's the idea, though. Some people say, well, is a debit good or bad? Well, it depends. If it's an expense, maybe not so good. Debit as an asset might be good. And so, it isn't the debits are good or credits are good. It depends on the account. So you say, okay, debits aren't all good. How about credits? Well, credits are bad if you're an asset. Credits are good if, say, your revenues. And if you're wondering how this kind of comes about, there actually is a method to this. Oops. Let me do this. Okay, we'll make these yellow. These are all money going out. And this side is all money coming in. So the debits will all increase for expenses and assets. These are things that you spend money on. So this is money going out. You spend money on expenses, you spend money to get assets. Over here, oops, no, don't do that. Let me try this again. Okay, that's what I wanted to do. You notice that on this side that everything that is money coming in goes up with a credit. So expenses and assets go up with debits. Revenues, this is money coming in. If you sell something, you get money in. Liabilities, if you borrow money, money comes in. Or equity, if the owners throw money in, money comes in. So this side is all things going in. And this side is all things going out. So this is what you spend. This is how you get money. This is how you spend it. All right. So if you think about the balance sheet, it's sort of like it goes up on the outsides. If it's an asset, it's going to go up with a debit. If it's a liability or equity, it's going up with the credit. But we'll get more into this as we go on. Okay, so let's go back to our original problem. Okay, so here's how this one works. Just like we did before on that on this thing, we figured out that land and cash were what we had to do, those are the accounts. I won't get rid of some of this stuff. it's not letting me get rid of things. I don't give this up. We'll get rid of Luca here. All right, so the two accounts we use are cash and land. And if you look back here, cash decreased, right? Okay, so cash is an asset. And it's going down, it's decreasing, so it'll be a credit. So down here, you'll see that cash is a credit. Again, forget everything you know about debit cards, crediting your account, all that kind of stuff. It has nothing to do with what we're doing. This is sort of like being left and right. That's basically what it would be for us. Now, land is also an asset. It's increasing, so it'll increase with a debit. So land is increasing, cash is decreasing. And from this, you could say, okay, it looks like they bought land. Right? Cash went down by 300, land went up by 300. They bought land. So just from this, and even these are, these are optional. I just put these in there. The journal entries wouldn't have these. That is basically the journal entry. 4 things: land, cash, debit, and credit, and you can know exactly what the transaction was. And that's why these are still around. Every now and then we'll have people say, well, let's get rid of debits and credits, and they come up with something that is exactly the same, because it's actually a very ingenious system. Okay, so we're going to start doing these on our own. And you can always look back at what we did over here. Okay, so for instance, paid cash for equipment. And just like we did last, that's not it. Just like we did last time. We have cash, equipment. So cash is going down, equipment's going up. Okay, so the two accounts would be cash is decreasing. Equipment which isn't spelled like that, is increasing. Okay, well, I say, okay, well, what kind of accounts are these? What kind of account is cash equipment? Well, those are assets. Okay, so cash, it's an asset. It's going down, we'll get credit. So coming down here, we put a date in just to let us know when it was done. That would be and the accounts. I'm going to show you that they usually put these in the order of debits and then credits afterwards, and we'll talk about that in a second. But yeah, I'm just going to go ahead and put it in the way they'll show you in the book, and then we'll talk about it. Okay, so cash is decreasing. Cash is an asset going down. It'll be decreasing, so it'll be credit. $400. And equipment is also an asset and it's increasing, so it'll be a debit. Okay, so this is an asset. Oops. You do not need to put this in. I'm putting this in so you know how I came up with a debit or credit. So these are optional. Okay, it should be capitalized. Okay, so here are some of the quirks about journal entries. The first quirk being I can't get it straight, but you indent the credit. So the credit is indented. That's the first kind of quirk for this. Now, that is something that is shown in textbooks, and if you do it online, they'll mark you off if you don't indent and all this kind of stuff. Quite honestly, there is no rules on that, but it's the common way that you'll see it is that cash will be indented. The other thing that's kind of quirky that is not really part of Um, it's not an actual accounting rule. Oops, that's not an actual number either. Is that they will generally show debits first and credit second. So the cash is usually indented. They should usually go debits first, credit second. If you're doing this online in an online class and you put the credit first, it'll mark it wrong. There actually are no rules on that. And I've been in business and I've seen journal entries where they start out with credits, and sometimes they'll have 10 accounts in there. There'll be debits and credits all over the place. So while these aren't really rules, accounting rules like you have to do, they actually are in your accounting classes anyways. You need to follow those if you're putting in, or they get marked incorrectly. In this class, it doesn't matter to me. You can put the credits first, that's fine. If you don't indent them, it's not that big a deal. As long as you have as long as you have the credit and debit in the right spot. I don't, if these aren't indented, that's fine. If the order is different, it's not fine. However, when you go on to, if you have a different instructor and you're going through the textbook, they usually say this has to be indented and the debits must come first. So if you're doing online homework, they'll ding you if it does. Anyway, so anyway, that's our first journal entry there. So we have the equipment. And then someone familiar with this would realize that this is, they bought equipment, cash. That's all you need. Again, it's a very efficient system, but it's not the easiest to use. Okay, so let's start going through these. All right. Let's put the accounts in. So we have mortgage, mortgage payable. My writing is worse than normal. They bought building. Landy. Okay. So the transaction. Is the mortgage payable going up or down? Is it increasing or decreasing?
So that would be increasing.
Yep. How about the building?
It's increasing as well.
Yep. And you probably get that too. The land would also be. So these are all increasing. And notice that this is a liability. So the liabilities are going up. But then when it make the balance sheet balance, these two also have to go up, right? So everything is increasing in this one. Okay, what kind of an account is mortgage payable?
An asset.
Actually, the payable isn't going to be an asset. What these are going to be assets, but the mortgage itself, you sign the papers at the bank or whatever.
It's a liability.
Yeah, probably be a liability. That's what you're going to have to pay off. So the mortgage payable is going up. In other words, you owe more now, $3,000 more. So this would be the mortgage payable. So that. The building is what kind of an account?
Asset.
Yep. And the land.
Asset.
Yep. Yeah, it is. Okay. So these are the three counts: mortgage payable, oops, building and land. Okay, so it is important to know which category it goes into. And again, it is kind of amazing that all the transactions you can possibly think of fit into these categories. Okay. All right. So let's take the let's go ahead and take, oh wait, let's put the date in first. Okay, so this is the date the transaction happened. And so let's take the building here first. Okay, building is an asset. And is it increasing or decreasing?
Increasing.
Increasing. So will it be a debit or credit?
Debit.
Building is going up, so it'll be a debit. How much is it? 2,000. We got that one. Land. It's an asset and it's increasing. Okay, so land, it's an asset. It's also increasing. So it'll be a debit. Oh, I didn't put it in. Okay, and mortgage payable. I'm going to indent because it's a credit. You do not have to do this. Oops. And you don't have to put it in the order of debits and credits. And this is a liability. And it is also increasing. This needs to go like that. And it was going to what, 3,000? Oh, I didn't ask. Yeah, I'm paying attention. Okay, mortgage payable. It's a liability. And it is increasing, so it'll increase with a credit. So notice that even though all three of these are increasing, it doesn't mean that they're all debit, or all credit. They're ones of each. And you're going to kind of notice something too as we go along here, and that is that these debits and credits have to equal in total. Right. And so this is, the total here is 3,000. You don't need to put this in. Oops. You know, you don't need to put that in at all. But you'll notice that the debits and credits have to equal. Now, again, you can not every account is going to equal something else, but in total, right? They have to equal. And this would be sort of like this here. This is what actually would happen. We had the land and the building. Assets went up. And over on this side, liabilities went up by, so this side went up by 3,000, this side went up by 3,000. So it's kind of like on the outside they go up, on the inside they go down. But anyway, so if you have liabilities going up, well, something has to offset that, and that is what it is. So debits will always equal your credits. Now, there is a beauty to that too. I think I have the wrong version of this. This is not my latest version of this. It's not the right version. All right. We'll go to the next one. We'll go to the next one here. I just want to mention something. Okay. So supplies are purchased on account. So we had the two accounts. Supplies. Oops. And what's going to be on the other side? What's going to be the other one?
Accounts payable.
Yep. Again, if these seem strange, they should. We are looking at 400-year-old shorthand. Okay, so for this one, supplies, did it increase or decrease?
Increase.
Mm-hmm. Accounts payable?
Same thing.
Yep. They both increase. We got more supplies, but now we owe more people. Okay, so go ahead. Okay, so the supplies are assets. And what are the account? Sorry. Let's try that. So supplies are assets. Accounts payable are what?
Liabilities.
Yep. Date, February 13th. Okay, supplies are an asset and they're increasing. So will it be a debit or credit?
Debit.
Yep. Here, right? Okay, so it's supplies. And it's an asset. Increase. Okay, accounts payable is liability. It's increasing. Will it be a debit or credit?
Credit.
Now, here's the beautiful thing about this method. For the most part, if you only have two accounts anyways, if you know one, you know the other one, right? I mean, if you couldn't remember exactly what supplies or what accounts payable went, what is that account? If you know what the supplies are and you get the debit, you get that, then you know that the other one has to be a credit. So there is also this sort of built-in kind of safety thing, so not to make a mistake. It doesn't work for type. So anyway, so you have this kind of built-in thing though, that if you know that one side is a debit, then the other side has to be credit. And that would be particularly important 400 years ago because they didn't have calculators or computers. Even your modern calculators are pretty new. I mean, they for the general public in around late 1960s, which sounds like a long time ago, but we're not talking about hundreds of years ago. We're talking about whatever, fairly recently. I'll put it this way: there's people alive who, when they were born, they didn't have calculators. So yeah. So anyway, so this is supplies. It's a debit. And accounts payable is a credit. And again, the debits of these two have to equal. If you run into a problem where you do the work and you have two debits or two credits or whatever, excuse me, go with the one that you know the best. If you can't remember if supplies are an asset or whatever, if you know like accounts payable and liability, go with that one, and then put the other one on the other side. But your debits also have to equal your credits. Okay. Borrowed cash from the bank. What accounts?
So cash is gonna increase and mortgage payable is gonna increase.
Now, here is the tricky part. Cash, and I think you guys pretty well know it's an asset, so I won't bore you with that. Mortgage payable, anything that's a payable is going to be liability. So is the cash going to be debit or credit?
Debit.
Yep. Cash is increasing. Debit. Mortgage payable is also increasing to be credit. Oops, oops, oh, what am I doing? Again, if you have one side, you know what the other side is. It is kind of amazing. There's only 4 things written down here: date, 2 accounts, and the numbers, which are basically the same. So really, through just 4 bits of information, you can know that they borrowed $5,000 and they used the mortgage to do it. Okay. Issued common stock for okay, common stock. Is it going up or down? You have more owners or fewer owners?
More owners, it's going up.
Yep. And cash, increase, decrease.
Increase.
Yep. Yeah, again, this goes back to, I know this is kind of a strange thing. Whenever they say issue, that means sold. Whenever you sell something, you get money in, cash in. So when they say issued common stock, that means they sold common stock. They give them common stock and they receive money, cash back in. It's possible they receive something else, land or something, but usually it's going to be cash. Okay. We all know that cash is an asset. Oops. What is common stock?
Equity.
Yep. Okay, and the cash increase. Equity increase. Okay, so April 3rd. And again, I do not care which order you put it in.
So wait, I'm sorry. You said that equity increases, right? The common stock. Is that supposed?
This is wrong. I am thoroughly embarrassed here. I think I sent the wrong version of this out. Just a second here. That is definitely wrong. What was listed on there? It's wrong in all of these. Oh man. And there's something else that's not listed on here that is the reason why I say that this is the wrong version. Is that this should be expensive and there should be a parenthesis that says dividends. It's not on there. And I cannot see any other place where it is. There's one more place. It's not there. I have no idea what I did. Okay, yeah, this is wrong. Man, oh man. It's embarrassing. This should be decreased. It should be the same as this. Thank you for catching that. That's you cut it on the first one, so that's kind of kind of, it's not kind of good, it's really good. And thank you for bringing it up, because I try not to have it happen, but sometimes I'll soon say, well, where did this come from? Because I'm an idiot, I don't know how to, I don't know what I'm doing, but it should be, yeah, it should be the credit will increase it. It should be like this. I really am wondering what happened. Because this is supposed to be expenses, and then the parentheses have dividends around it. Which is I know I made it, I don't know where I must have saved it somewhere strange. Okay, so cash would be 2,000. And common stock will be 2,000. And yeah, make sure you, what am I doing here? Make sure you make this correction in my thing. This should be decreasing. It should be the same as the liabilities. The only thing I can think, or the only thing that may have happened too, is it might have accidentally done undo. That's the only thing I can think of, to be honest with you. It was almost positive that this was all up to date. And the expenses thing was the last thing I did, so this would have been before that. Okay, sorry about that, guys. We're not going to finish this today, so the one I'll send out tomorrow will be corrected. Doesn't help us today, though. Anyway, okay. So issue constant. Okay, so that's that one. Yeah, and then that again, make that change. Okay, received cash from a customer previously billed. What accounts?
Cash and accounts receivable.
Yep. Okay, so what happened with the cash? Did it go up or down?
Up.
Yep. And accounts receivable?
Down.
Down.
Yep. Okay, so cash is an asset. What is accounts receivable?
That revenue?
It actually usually comes about by revenue, but it is as of itself, it's not a revenue. We actually, I don't think we'll get to it tonight, but actually tomorrow we'll get into the revenue side of it.
Okay, well, an asset.
Yeah. Yep. Hey, okay. So these are both assets. Cash is going up. May 12th. So cash is an asset. It's going up, it'll increase with a debit. And accounts receivable is an asset, it's going down, so it will decrease with a you know something else about this that is nice about this this fast way of doing the journal entries. You know, kind of like a shorthand way of doing the journal entries. You know, how many times have you pulled out the calculator? None. You know, unlike, oops, not that. Unlike this, you know, we didn't care about all this other stuff, but we really didn't need to record the transaction. So, you know, there's no calculator, but it, you know, a lot of people think that accounting is heavy into calculation. For the most part, it's not. I mean, there's pluses and minuses on the financial statements, but recording the transactions, you know, you can easily do these most of the time without a calculator.
Generally, would you make a journal entry after each transaction?
Yeah.
And then what, like the end of the week, you would do like a balance sheet?
Yeah, exactly. And at the end of some time period, you do a balance sheet. You may do an income statement too, just to make sure the accounts are all up to date and all that. Your accounting is actually, it's not for the accountants. You know what I mean? I mean, we do the accounting. When the transactions happen, we record them. It's historical for the most part. But we actually are not usually the ones that use it. So usually they'll run the financial statements, not for the accountant, but usually for the other people that need the information, managers and upper management and all that. I've been at places where they ran them weekly. I've been at places where they ran them monthly. Many places will run them quarterly, every 3 months, and virtually all places will run them at least once a year. But yeah, and again, you know, it's just up to the company as far as how often they do that. Except for publicly traded companies, if you can buy stock on the stock exchange, they have to do quarterly financial statements, right, to keep the registration. So, yeah.
Okay, that makes sense.
This one's exactly the same as the other one. This one, except for the dollar amounts. And for these ones that are repetitive, you know, these ones that are do the same thing over and over, a lot of times they'll have what they call a journal. So they'll have a sales journal, accounts receivable journal, payables journal. You know, they'll have ones that they'll do all these transactions, and basically because the journal entry is the same, all they'll be doing is entering someone's name and amount, you know, and it'll automatically put that into the journal entry as an even quicker way than just grabbing it to account. Okay, so oops. Customer paid towards their account. Again, this, I think I just put this in there because I think a book has something like this. As you go through, you kind of get the hang of it as far as what goes. You know, the cash account, people virtually get that one right all the time because it's used so often that cash goes out with a debit, cash goes down with credit. People, that's one of the ones that people pick up, you know, the quickest, just because it's used so often. Okay, cash and accounts. And just like before, different day, May 13th. Cash, an asset, it's going up with a debit. Accounts receivable also an asset, but this one's going down. They no longer owe us $100. They owe us some other amount. And again, we're just grabbing the 2 accounts that we need and going on. That's it. All right. Paid off a few accounts payable. What accounts? What do we pay them with?
Cash and then accounts payable.
Yep.
So the cash will decrease and the accounts payable will decrease.
Yes and yes. So cash is going down. And so is that. Fix these. This bugs me. Okay. So cash is going down, and so is the accounts. Okay, cash is an asset. Accounts payable is
Liability.
Yep. Cash is going down. Okay, so cash would be credit. Maybe I should code it like that. And then accounts payable is also going down. It will also be, no, it won't be, it will be a debit. Those are all be a credit. Okay. All right, number 10. Payment towards accounts payable 1,000. This will be same as the other one. Cash instead of accounts payable will be mortgage payable. Oops, letter. And accounts payable. By the way, you can also abbreviate. Accounts payable, a lot of times you'll see this just abbreviated as A/P. I tend to write it out just because no, I tend to write it out just because so the students that aren't as familiar with it, see what it is. But you feel free to abbreviate AP, accounts payable, accounts receivable, AR. They're fairly common. Okay. Cash is going down. Ooh, wee. And accounts payable is going down. 9. That is not right. Be a mortgage payable. Okay, so cash is going down. Mortgage payable is going down. Okay, so cash is going to be credit, and mortgage payable is going to be debit. 827. Okay, purchase office equipment on credit. Okay, I think that'd be here's what we're gonna do. We're gonna do numbers 11 and 12, then we're gonna stop. We're gonna leave the rest of these for next class. Go ahead and see if you can work through them, see if you can get them, if you haven't already. Okay, so let's see, office equipment or just equipment. Credit, might be accounts payable. Let's change this. Okay. You can just put equipment too, that's fine. Hey, this is today. June 9th. It's okay, I forgot what I was doing. Okay, office equipment. Oh. That looks funny. Okay. So for 11, should have office equipment and accounts payable. And here you should have supplies and cash. Questions like that? And again, if this is confusing, it should be. This is the first time you've seen it, or most of you anyways. So, you know, the first time, I remember the first time I saw journal entries, it made absolutely no sense to me. But, you know, so if it's confusing, it should be. We're basically learning 400-year-old shorthand. Now it does work though, then that's why it's still around today. If believe me, if they could have replaced it, they would have. But yeah, so journal. Now a lot of times, if you're doing bookkeeping, those sort of things, you'll have what they call a journal. The journal for things that happen routinely, like daily, buying supplies, that may be a daily thing. Office equipment probably not so much, but certainly receiving cash from customers, that would be daily. If they will actually have a journal, you kind of total them all up and then enter it all at once. So you add up all the ones for the day for accounts payable and cash, but the journal entry is the same. Every single person that sends you money, the journal entry is exactly the same. Everyone that pays in their account. So there are a lot of journal entries that are so common that they'll actually just make a journal and say, okay, here's all of them that are going to get this treatment, basically. Question on that? Okay, well, the one thing I am going to do, I'm going to correct the handout immediately and send you guys a corrected one so that we don't have, well, that was right, but so we don't have this happening, being correct. And I'm also going to fix this over here. All right, so hold on to this handout. We're not going to turn this in. We will probably finish it next class. We're going to spend a little bit more time on this. I know this is a very fast class, but this is one of those things that if you don't spend time on it, it makes the other chapters go slower. So we're going to spend a little bit of time on it just for that reason. I'll put it this way: a little bit of time spent here saves a lot of time later on. So next class we'll go ahead and finish this up. If you haven't turned your chapter 1 stuff in, I would encourage you to do it, just because going into this chapter 2 stuff, which is kind of seems very different. It can sometimes be confusing if you have a lot of things going on. All right, any questions? Okay, so we went up to page 12, or problem 12, I should say, page 7. And we will stop right there. And next class, we'll pick it up. Questions?
Nope. Have a good night.
Okay.
Thank you.
See you guys.
Bye.
Bye.